All right, greetings all you traders out there. Sam here from TradeDevils.com and TradeDevils-Indicators.com. So today we are releasing a new indicator in the Ninjatrader 8 suite of tools that we make available. And I'm a little bit different today in that I'm prefacing the release of this with a bit of a mini course here. This is just different enough to where if you had not been exposed to some of the theory, the concepts, and the nomenclature here, you might be a little bit lost and you might not appreciate some of the value or the potential here in this indicator. So I'm going to try and do this as briefly as I can, but I'm going to need to go through a little bit of theory. And then as quickly as I can, we'll move through the theory and then into application so you can start to see the pieces come together. Now, we call this price action trading, but now, of course, price action trading is, I mean, everything is price action trading, but it really, this moniker of price action trading, it's really, I suppose, pioneered in the early days by Al Brooks. I guess you'd call that classic price action trading, and it's the idea of trading purely based off of price action or candlestick chart, and you're not relying on indicators. So that's kind of the historical reference to price action trading, if we use that category. Now, of late, let's call it the last 6 or 7 years, a subset of price action trading has become quite popular. It came from the Forex markets. Now, the Forex markets are unique unto themselves, unlike other markets, for a couple of reasons. Well, number one, they dwarf every other market I mean, if you combined all the trading in every other market and tallied it up, Forex would still dwarf it. I mean, it's trillions and trillions of dollars exchanging hands every single day. Now, what additionally makes it unique is that of those trillions of dollars that are moving back and forth throughout the course of any given day, about 90 to 95% of that is done through 6, 7 major institutions, banks, if you will. So that unto itself makes the market unique. The size, the fact that there are relatively few players that move money back and forth. And then additionally, the fact that the Forex markets are not centralized. So the exchange prices vary, volume would vary. So because they're not centralized and the price on one exchange is not necessarily exactly the same on another exchange, a couple of things happen. One, Forex traders do not get volume. They can get tick volume, but they don't get actual volume. Additionally, in the Forex markets, we have traditional market makers, right? Because of the lack of centralization, there are market makers that are providing liquidity, and that creates some interesting interaction between those mega institutions that are moving money around and then the interaction with market makers. So it creates somewhat of a unique concoction of dynamics in the Forex markets. Now, the subset within price action trading that has been popularized in the last half dozen years or so came from, I don't know if he started it, but he popularized it. So let me say it that way. One individual trader, educator, really popularized the idea of the smart money concepts, or SMC, as you will often see it abbreviated. And the guy behind this, at least popularizing it, I believe his name is Michael Huddleston, and he goes by the handle of the ICT, or the Inner Circle Trader. Now, this is I suppose he's a semi-controversial character. It's either a love or a hate. Some people are completely devoted to his teaching and swear by it. Others will tell you it's garbage, doesn't work. You have to draw your own conclusions there. And I will say very, very specifically early on here in this presentation, we are not trying to replicate the smart money concepts that you find in the Forex markets here in the futures markets or even the crypto markets. We're not trying to replicate that precisely because there are nuances that are specific to the Forex market. What we're trying to do here, and what I typically will try and do, is look at a technical approach like this and pull out the strengths and then leave some of that nuance or some of the peculiarities that are specific to the FX market for FX traders. What we're going to do is look at the price action, if you will, the price action side of this, and then extrapolate from that some of the benefits of what I think is available to us here as traders as we implement this and look at how it can overlap with what you're already doing. Or certainly you could approach the market with this technique and trade it exclusively, or you could add it in and augment what you're currently doing, which is typically what I do. But before we get into the specifics and we get into the indicator and we get into the charts and the real time and we demonstrate it, we got to go through a little bit of theory here. So if you'll bear with me, some of this is it's going to strike you as very rudimentary because it is, but when we move beyond theory and line drawings, and then we get into the charts, you'll find that it's a little trickier than you might believe at first glance, right? So when you first see what I'm about to take you through, you're about 5 minutes into this, you say, yeah, I got it. Well, okay, so bear with me, if you will. There's a destination in mind here. But as we work through the very fundamental theory here, eventually when we get to the charts, I think you will, like I did when I first started applying this, find that it takes a little bit of practice. It takes a little bit of time for your eye to see what I want you to see, and what hopefully I'm going to open your eyes to if you've not seen this before. And I think there can be real benefit here for us as traders, whether you want to incorporate this into what you're doing or do some experimenting with it in either futures or crypto or whatever market you currently trade. Certainly, you can take this into the FX markets. Okay, so enough introduction there. So with that said, let's deal with some of the basic theory here and get this out of the way. Okay, so one thing I've got to do here, because you can't see my mouse here, so I've got to use this little laser pointer here since I'm doing this on a PowerPoint presentation here. Okay, so if you'll bear with this little laser light. Okay, so this is certainly not revolutionary to price action trading. This is how trends have been defined for as long as people have been writing down prices and putting together the bar charts or candlestick charts. So this is simply just the definition of a trend, a series of higher highs and higher lows. Well, now we're going to put in some specific language here to refine and define these more clearly. So in this context here, I've got a swing that gives me a high. I get a retracement that gives me a high or low. Now, in order to identify the ongoing trend, I need a break of structure. So I need this low to push past this high to give me a higher high. And then we're going to call that move where we break this prior high a break of structure that leads to the new high. Retrace, I get a higher low, I get another break of structure, and on we go. Of course, it's the same thing coming down. Absolutely as rudimentary to technical analysis as it can be, very deliberately so. Now, with that said, that's the theory of a perfect line drawing here. And of course, that's not how the market is going to necessarily present itself to us. So often we'll have a swing here, and then we'll have an uptrace here, and then there'll be internal swing structure here. But the broader swing structure here is not changed unless we were to come down and take out this lower low down here. Well, here, if I switch to the pen tool, let me try that. So here's the low that's important that drove off and gave us this higher high. I've heard it described this way by another educator in the SMC space, and I liked it, so I'm going to borrow it. In the context of an uptrend here, or a downtrend, either way, once we create a lower high here, if this trend is going to continue, if we're going to continue in this uptrend here, then this low has a job to do. It has the job of creating a new high. Let me go back to the laser, right? So this low has a job to create a new high. In order to do that, it has to break the structure of the prior high. Now, inside the internal swing structure here, which is well, of course, that's what the market will present to us here. Now, we'll deal with this as we progress through this little presentation, but for the time being, what I want you to focus on here is that this is the strong low. If I go back to my pen toe, here's the low that matters here. So we are in the range here between this low and this high. All of this is not relevant to my swing structure unless it either breaks the low down here or breaks the high. Right? If we break the low, well, our trend has broken. If we continue on and we break the high without breaking the low, then of course we have the ongoing trend. Higher high, higher low, higher high, higher low, and of course the exact same thing on the way down. Now, moving forward, of course, what this creates for us is some specificity with how we're identifying highs and lows. So let me go back to my laser here. So with the swing here that retraces. Now, at this point here, we don't know the outcome. We just know that we have a swing, and at this moment in time, we have a retracement internal to those highs and lows. If the market is going to continue to move higher, we have to break the prior high. If it produces a higher high, then this becomes a strong low because this is the low that did its job of creating a higher high. So this in turn becomes a weak high as it was broken by the strong low. Right now, if we start to retrace, we do this again. Now here, again, I don't know the outcome. I just know I have a stronger low below. And as long as we stay above this low, I have the potential for this trend to continue. It continues only if and when I break the prior high, which gives this the identification as yet again another strong low because it broke the high, making this a weak high, and now we get another high. I don't know what this is going to be at the time, and if I get a retrace here and then that breaks, then I get another low here, another strong low that breaks a weak high, and on, right? And of course, the same thing coming down. But it lets us specify strong or weak. What is the current range that we're in? Now, this will be important here as we add complexity to this, but I just want to start you here on the basics. Now, of course, the market's not going to give it to you in that perfect line drawing format here. We're going to get a swing, a retrace. We don't know if it breaks. Oh, okay, I got a weak high, I got a strong low. Then I'm going to have all of this swing structure here, this intermediate swing structure here. This could be a 4-hour chart, and this would be 15-minute substructure here. That, of course, this is just naturally how the market moves. But our context here doesn't change as long as we stay above this low. As long as the uptrend stays in place, we continue to define it as an uptrend as long as the highs are being broken and the lows are staying thus as higher lows. Right? Higher low, weaker low because it breaks. So and of course, the exact same thing coming down. We will get to this substructure here because this can be useful to us as we progress. But let's just stay with the original concept here of defining trends through those structures up and down. Now, how do we define a trend change? Well, okay, we got to be specific here. So just staying consistent with what we've just been looking at here in terms of the uptrend. I'll pull that off here. So if we now are going to start to look at the potential, how do we define a trend swing? Let's be a trend change. Let's be very specific about it. Well, when we get to this point here, well, let's use my laser here. When we get to this point here, I have a break of structure. So this is the low that did its job, that gave me a higher high, but on the retrace here, I did not get a higher low, right? So this is a pivot high and that was intended to retrace for the trend to continue. I'd need another push to give me a new high, but I get a break of a strong low, right? So this is the initial condition for the potential for a trend change. Now, let me go back to the pen here. Now, just because we have this break of structure here, that does not necessarily by itself determine the swing trend. The trend change, because we could easily just blast off from here and trend continues on. And this was just a bit of a fake break, if you will. The trend stays intact and off we go. We get a new high here. And this was just a little, a deeper retracement. Happens in the market all the time. But where we can and when we can, we want to try and identify when those trend changes are happening. So this is the first conditional component of a trend change. We get a break of structure, but I can't call it that by itself a trend change. In order to confirm the trend change, I need a retracement that will give me a lower high, and in turn, this lower high has to give me a break of structure that will give me a lower low. So when I have those conditions, now this becomes the stronger high, this becomes the weaker low. I get a confirmation here because I get a lower low. So this is the pivot. This pivot high did its job of creating the lower low. Right? So this is the first condition, break of structure. Then I need a retrace here that gives me a lower high than the previous strong high here. And then I need a secondary break of structure here to confirm the low so that I know in turn that I have now a stronger high here that produced a lower low. So this is the pivot that did its job. Now, if I retrace and that continues, I get another strong high here. It's a lower high. It does its job. It breaks the structure. This becomes a weak low, gives me a strong low here because this pivot did its job, gave me a lower low. Right now, so if we're going to come back the other way, let's erase that. Let me come back here. If we're going to come back the other direction and we're going to get a second trend change, right? If trend is changing throughout the course of the day, of course, it would be a function of the time that you're trading on. This could be a 1 minute chart. You get trend change 12 times a day. If you're looking at a monthly or a weekly or a daily, not so much. But here, the time frame doesn't really matter. I just want you to understand conceptually how we define the trend change. Now here at the break of structure, yet again, this is not the trend change. This is the start, the conditional start of a potential trend change. If I get a higher high here, then this low has done its job of giving me a higher high. I need to retrace. Now, is this low going to do its job? If I get that break of structure and it gives me that higher high, then I get a stronger low that breaks the weaker high. And then we have the conditions for that trend change. But I can't confirm the trend change. As I said, just to emphasize this again, I don't have a trend change here. I have the conditions for it. I don't confirm the trend change until I get the second break of structure, so I know I get a higher high. All right, so hopefully that makes sense. We got to be specific about how we define a trend change here. So while there are some that might tell you, oh, with just a break of structure here, oh, we've got a trend change. No, we can't define it till we get the lower low. Okay, with that said, now let's talk about some of this internal swing structure here. Well, so here, if we were looking at some of the internal subswing structure here, well, here just clearly, if we got a series of higher highs and higher lows, when we come to this point here, I have not necessarily a break of structure, but I have a change of character. Now, change of character, this is, we're going back to Wyckoff days here. We're talking about change of character. But it's applicable here. So it's not, a change of character is not necessarily a break of structure. It could be a break of structure, right? But that's a function of what's the range that we're trading in. So let me go back to my laser because I think this gets harder to see. If this is the dominant low here, and this is the structure that we're in, this is the dominant high, these internal swings here, we can see a series of higher highs, higher lows. We can see that substructure change without changing the larger degree trend. Right? So these little internal changes of character are meaningful. This is often how we'll set up a trade, but we want to be mindful of what the larger, the higher degree trend is, so we know whether or not we are looking to get in alignment with that larger degree trend or if we're counter trend trading. Right? Just we want to be clear about how we're defining things. Now, of course, again, the market is going to give you a little bit more complexity than what we're seeing here in these line drawings here. So here we get a nice uptrend here. Now, this little pivot here, at this point here, nothing has happened here because we're still within the uptrend. But when this series of higher highs and higher lows, all of a sudden, I get a change of character here because all of a sudden within the internal substructure, I get a lower low. Now I get a lower high. Now, it's important that you recognize here that I do not yet have a trend change here. Just as a result of the change of character in the internal high, I have a break of structure here that creates the trend change, just as we went through it previously. A change of character is not a change of trend. It's not until we have a break of structure where we have the first ingredient of the change of trend. I don't confirm it until I get a lower high that gives me a lower low. Thus, now at this point here, I know I have the conditions for the trend to have changed. And the same thing here, and there'll be more complexity here. Again, of course, the market's going to make it a little trickier for you, but uptrend is just as we looked at it over here. We get a little change of character here. Now we can get complexity here where we can have multiple changes of character within that substructure, but the broader trend remains intact. Right? This is most commonly what you're going to be faced with when we go into an actual price chart here. So here, this is what you'll be faced with when you're trying to apply this to a chart. Now here I've marked out all the breaks of structure and all the changes of character along with the higher highs and the higher lows. Here, I think this is a 5 minute of the RTY. So what you'll note here, and it takes a minute again for your eye to see it. Oh, let's get my laser. Here, let's do it that way. So from the low here, first thing I get is a break of structure, right? Then I get another break of structure. So I have an uptrend coming into this, right? It wouldn't matter. Just in this section of the chart here, I've got a break of structure. So I have an uptrend here. Now I immediately fall into a downtrend after that uptrend. So here's the break of structure that sets up the initial, that's just the potential for the trend change. Here's the second break of structure, third break of structure. Right, so I've gone from this uptrend to a downtrend, and now I go back into an uptrend, right? So here's the break of structure. As we get that, so we get change of character, break of structure, gives me the new high. Now I come back down, I got another break of structure, another break of structure. Right, so now I've gone into a downtrend. Now here I get one break of structure, I don't get the second. So I retrace. This is a teaser, a fake break. Now we come back down, it's break of structure here. So it certainly, the conditions are there for a downtrend to establish. Now I get the change of character, break of structure, down we go, and then I get another break of structure here. So I confirm it here because now I've got two breaks of structure. So we've gone from uptrend, downtrend, downtrend, back into uptrend. Right, now this is a 5-minute chart. So here's break of structure. Here's a little fake break. I break structure here, but I don't get a trend change. Now I'm back to here. I have both a change of character and a break of structure. So now I go into a pretty serious uptrend. Here's another little fake break here. I don't get a trend change. I carry on because here's the break of structure here that leads to this break of structure. Then I get another break of structure. So my point being, line drawings are going to make this look easy. Once we get to a chart here, marking all of this off and trying to follow it, and what are we in an uptrend? Are we in a downtrend? Where are we? Can get a little more challenging, which is why I wanted to take you through the theory first. So as we take this to more and more examples, it'll start to get easier for you to spot these here. Now, one of the things that I want to focus on here is just kind of coming back to keeping it a bit simpler here, if you will. So we will return to the complex momentarily here, but let's just focus on this here. So this idea, one of the things that we know about the market is it likes to find a range. You can consider this consolidation. You could consider this where the market's found fair value here. I guess we can switch that off. We found value here. We found a range. Time frame wouldn't matter. This could be a 1 minute. This could be a daily chart. Doesn't matter. Once we break out of this range, we come down here. We have imbalance, right? And it's emphasized here in this last candle. So we've moved from a place of value or consolidation or however you want to think of it, a consolidation here, and we're now moving away from balance through imbalance, and we're seeking new value. So we find it down here. Again, the time frame wouldn't matter. This could be a 1 minute chart. It could be a 4-hour chart. We find a new range of value, a new range of balance. Now we come out of that via imbalance. Right now, are we going to hold here, or are we just going to carry on? Well, of course, we don't know until we see the results of. Let's get this off of here. Oh, hang on a sec. Let's get off that here. So as we push into that, we don't know the result here, but we can spot the new range as the market wrestles with whether or not this is going to be value. Are we going to stay here? Are we going to move on? Well, in this case, we move on. So what you can see here is we've gone swing, we've had retrace, and now we go forward and swing, right? So the swing structure here is moving. Now, of course, we could look at this a couple of different ways, but for the time being, for just this first example, let's just focus on this range here and how we might deal with that kind of a range. So we can identify it, and here if you would allow for this to have blown it up. Again, wouldn't matter if this is 1 minute or a 1 month. It just wouldn't matter here. So, but we find ourselves in this range. So how we can qualify the range by cutting it in half. Now this is, when we see something like this is. We could kind of find ourselves in the language of overbought, oversold. And here, this is, if you're tracking indicators, this can often be an area that will give you some opportunities here, but we just are identifying it as a range. And we can approach the range by looking at the lower half of it here. If we just cut it in half, we can define the lower end of the range. Let's go back to my laser here. This as being the discount. equilibrium being at 50%, and then the upper half being at premium. So ideally, right, we want to sell high and buy low. We can buy low and sell high. Now, of course, that's idealized, right? That's usually not going to be the experience that you're going to have in the market, but we want to be able to identify it. And most importantly, we want to be able to clearly and simply identify where it's expensive and where it's cheap. So as we think about that in terms of the market moving in these examples, as we were just looking at here, again, time doesn't matter here. We're in a range. We move out of that range through imbalance, aggression, seeking new value here. So then we find a new range here. Now, as we come down, we don't know if this is a reversal or if just we're coming back here to a potential support zone here where we would get continuation. So in this case, we'd have the range, found a new range, retraced back to the existing range where we found support. And then we moved on. So we get a low here that produces a high that gives me a strong low here because it does its job and gives me a new high here, right? So the process continues. I mean, here it is in a chart, right? So the range isn't going to be always just perfectly even highs and even lows, right? Of course, right? The reality of the market. But we can identify a range here, and then we move into a new range here. And as we retrace, I'll be coming back into a potential support. It's always just potential support. We don't know that it's support until we see how we come out of there. But you can, excuse me, you can look at this, and just as we were just highlighting it here, we swing, we get a higher high, we retrace, we get a higher low, and then now here we get a higher high. So these areas here are important to us because they potentially support resistance for us. Now, if we move on from that, we want to try and identify these little ranges here. Let's go back to my laser here. Back to these little ranges here, because when we identify these, this is a way that we can establish potentially a place where we might look for a support or demand zone to be expressed in the market. So if we pushed out of this through an imbalance, if we come back to revisit it, well, a couple of things are potentially here that could drive us back out of it. Now, of course, we don't know that it's going to hold. Let me get my pen back here. We don't know that it's going to hold, but we can assume that if this came out of here aggressively, it's very reasonable to anticipate that there were orders here that may not have been filled. Or said differently, traders may not have gotten the price that they wanted. So the market gets away from them. Now, those orders could very well still be sitting down there. So as we come back to revisit this demand, well, let's call it a zone or a range, we don't know if it's going to be demand or not until we see the reaction. But we can anticipate a couple of things. One, there's potentially orders there that did not get filled that could drive us out of here. Additionally, bulls that drove it up right here could very well be defending those longs here by additional support, right? So these are buy orders getting filled. This would be additional buy volume here to support the trend, because if we're going to retrace, they're looking for a higher high, this low to do its job to give us that, right? So you follow that. And I think that's making sense to you here. And the same thing here. We don't know coming into this, if we're coming up to it, is this going to be a supply zone, or if we're coming down to it, here is this potentially a change of trend. We don't know until we see the reaction. Of course, that's a function of what direction were we going when we got to that zone. But same theory on the way down, right? Are there unfilled orders here? Are bears here that drove it down going to defend here? We can anticipate that. We can look for that reaction based on that expectation. No guarantee, right? Of course, it could easily blow right through that. But this is an area to draw our attention to and then see, are there other confluence points or other technical analysis or other components that we might look for to anticipate that we get that reaction there? And if we do, can we get on board, recognizing that if we're, well, we talked about this a little bit before, if we're in here and our stop is right here and we're looking for trend continuation, well, my risk reward here is going to start to look pretty friendly, right? If I'm going after that low. Right here's the low, right, that came up here. It did not give us a new high. If as long as it doesn't break that, we don't get a new high, so it does not do its job. We'd be anticipating that this is the pivot, right? It's going to go after the week low here, so I've got nice risk reward here. Right? It's a sloppy drawing, but I think hopefully you get the idea. So when we're looking at these ranges, we got to remember that there often are ranges within ranges. So we've been focused down here on this range, but we could just as easily call the entire thing a range, right? This could be a range If I emphasize this, so well, I know it's a little hard to see this pen, right? We could just be in that same range here on a higher degree. So how do we go about taking advantage of that and trying to qualify where we are within those ranges? Let me get that off of there here. Well, so again, coming back to this idea where we can divide a range between expensive and cheap, or premium and discount, and midline being fair value. This can be useful to us in terms of setting up the advantageous risk reward scenarios that we're looking for. So if we carry that forward to here now, this line chart that you've become quite familiar with. Oh, let me get my laser back on here. Here's the range that I'm in. Here's the last low that gave me a high here. This is not, we have no break of structure here. So I have the range here that I've defined where you see it here just from these white lines here. So couldn't I just as easily, right? Because this could be, I mean, this could be a 5-second chart, and we'd be putting this range on a 1-minute chart. This could be a daily chart, and these are all 15-minute swings. The point is not the time that we're looking at. It's the range, right? The range that we're in between let me say it this way, the strong lows and the strong highs. This is the range we're in. Right now, the trend has not changed. We are still in an uptrend. We're just in the range, in the midst of an uptrend. We don't know it's an uptrend, of course, until we get this ongoing break of structure. But we can use this concept of expensive and discount here to our advantage to try and identify those areas where it would be most advantageous for us to be pursuing a trade. So if we stay with that same concept here, now the same chart here, I'm just showing you how we could take the initial range from the low here to the high here, cut it in half. Right, so if the market is going to come down here, well, here's the first change of character. I come right to the midline. I'm not trying to make a point there. Just the idea here that if you were buying here, at least you're buying at equilibrium here. Now we go into the premium here, so it'd be more advantageous for you to be a seller. But note here, I can do the exact same thing. Once I get this range here to this pivot here, well, now I've got the same range right here, and I can divide that in half. So if I'm a seller here, I'm selling where it's at a premium, aiming for that low, which would put it right. So I'd have the risk reward up here for the potential reward down here. Of course, now getting very friendly. Same, let me get rid of that here. So the same thing happens again, right? So we're coming back in here. We're getting a retrace into the premium zone. This is the target, the low this is the weak low. It didn't do its job of giving me a new high. So this becomes the target. Down I go. Right, the risk reward here would be friendly. Now you don't have to risk up to this pivot, right? You could do the same thing and cut this in half. Oh, if I can get that drawing here. All right, so now I could be a seller here. Right, it's a question as to whether or not you're comfortable with that risk. Right, there's just the decisions we traders have to make throughout the course of the day. But what I do see here is after the change of character. Now, do you note here? I've got a little downtrend going on within my uptrend. Right, lower low, lower high, lower low, lower high, lower low, lower high. But I do not break the structure. That's what's important. Now I come back up. I get another change of character. Well, let's get back to the laser. I get another change of character, so now I've got a new range. Here's the pivot high, here's the low. So now I get a little micro downtrend, right? So lower lows, lower highs, and I get a new range here. I can cut it in half. So I can be a buyer down here. I'm buying below the 50%. I'm buying at discount. My target is minimum this high because that's the weak high that didn't do its job of giving me a new low. So up I go. I get a little retrace. I get a change of character. Now note what here, if I was looking to be a buyer here, I'm entering the market in sync with the larger trend. We know we're in an uptrend. We've had this long consolidation here, or this long range, if you will, if we're going to call it a range. Now, if I'm a buyer here, I'm buying at a discount within this last range here. Oh, let's get my pen back here. So here's the high, here's the low, here's the 50%. So I'm buying in the discount range with a minimum target of this pivot. I've got additional pivot targets all the way, right? So if I can go up here and get that here, if I were to get that, and that's aspirational, now I've got the trend continuing. So the idea is the trend carries on, right? Because I do not take out the low. So I am now buying in sync with the larger degree trend, right? It's an important concept to remember. So keep in mind now that every time, so now that you're getting dialed into these concepts here, every time we approach a strong high, we have to go through this same evaluation. When we get up here, right, is this potentially a supply zone? We know, right? So what do we know here? We know we have a strong high that gave us a new low. So this is the strong high. This is the weak low at this moment in time. Now, if it breaks here and we go up and we keep going here, a la the potential path here, if we break, then this becomes the strong low. This becomes the weak high. Right? So when we get up here, we don't know the outcome, but we have a slight edge here. We can lean into that idea here. And then again, we can create risk-reward scenarios here that would be very friendly to us. So if we're a seller up here and my stop's above that high and my target is the weak low here, this is risk-reward math that's good for a trader. Again, there's no guarantee we're going to hold here. Absolutely none. We've got a pretty solid uptrend going into it. Again, think of this as being this could be a 15-minute chart or a 5-minute chart, and these are 1-minute swings coming up to this. We don't know the result until we get here. What we're anticipating, when it would be this scenario here down below, that we're coming into that and we're going to hit this range, and depending on did we come into it from below, right? Now we're going to just reverse here, or did we come into it from above? And we're going to stall, and this is the retrace before that trend carries on. We don't know. It's always a function of what's come before it. And there are other tools that we can look for and things that we can use to evaluate, is there any additional edge that I can get here that would make me more confident to take that sell? Well, the one thing I do know here, again, looking at that range, I'd be selling in the premium, right, with a target down here, minimum target of the low that didn't, so I think that's starting to make sense. Now, one thing to recognize here is these ranges here, I'm drawing them with just line drawings here, but it's not going to look like, of course, on a chart. You're going to be looking at multiple candles. So this could be, a 5-minute chart. This could be a 30-minute chart. So a little range here, multiple candles on a 5-minute might be a candle or two on a 30 or a 60-minute before we get that big reaction. The same thing here. It's a function of what time frame are you looking at. So you take this down to the 1 minute, right? That's going to look different. Or it might be 1 or 2 candles on the 5-minute. It's just a function of when we push out of it, when we come back to it. How are we defining that little supply zone here, right? And so this is the classic down before the up, right, or often labeled as an order block. And that would be very specific SMC and specific to Forex trading, although it's applicable across all markets. But just that concept of the last up before the down, right? And that's not necessarily a candle. Of course, we can refine that even further here. But again, the point is to recognize that a lower time frame range could very well just be a higher time frame pivot or just a candle here. Right, so we make that distinction. The same idea applies. It's just, are we looking at a 5-minute, 1 minute, 60-minute, daily? Right, concept stays the same. Now, of course, we can refine this. Here it's just a candle, but we can refine it even further. So a range on a 5-minute could be a candle or two, a couple of pivots, the down before the up. On that's a 5-minute, and this is a 60-minute, and this is a 4-hour, and this is a daily. So on the 15-minute, that 2 candle, the down before the up, could be a couple of candles. On a 4-hour, it could be just 1 candle. If we take it out to a daily, it could just be the wick, right? So that wick on the daily could be a range on the 5-minute. So it's all just a function of how tightly we want to tune in for that potential zone. We'll look at a couple of examples of that when we get to the real market. Now, let's just start to combine some ideas here in our theory. So back to our very primitive uptrend, downtrend. Get my laser back here. So here being the first low that I've got, I get a swing, I get a high. Now note here, on every one of these retracements here, in order for this to create that new high, it has to break a supply zone. There's going to be resistance up here. How do we know that? Because money had to come into the market to drive it down. Right? So when we come back here, you could anticipate there'll be an effort to defend that. Maybe same phenomenon, maybe unfilled sell orders here that didn't get filled at the prices that they wanted on the anticipation that that's going to push lower and we'll take out this low, right? We don't know. But if it breaks, now I have a strong low. So if I come back down here to threaten that low, at the very least, I know that I've got a low that did its job, so it's more likely to be defended. Not guaranteed, right? There are no guarantees, but it's more likely. All we get is if we can find ourselves at a point in the market where we think we have an edge, that's as good as you hope. That's all you can hope for. So if I'm retracing into a strong low from a weak high, or from a weak, well, I don't know it's a weak high yet until it's broken, but if I'm retracing into a strong low, I'm more prone to be looking to the buy side here because it's a strong low. For this to become a strong low, I got to break the supply zone up here, right? And the same thing has to happen at every pivot. It's just the tug of war in the market between bulls and bears. So of course the same thing coming down. If we're gonna take out this low, we've got to break the demand zone that's there to give us the low here, to come back to give us a strong high. If we come back to that, we know this is the strong high likely to be defended because this is the weak low. If we're going to come in and take it, well, you follow along, right? So strong highs and strong lows are an important concept to recognize, and it gives us a way to label where we are, or to speak the same language. So if we were looking at a trade or communicating back and forth, or you're looking at it yourself, at least we can be specific about what pivot we're looking at. Strong low, weak high. Which one is it? Now, of course, the market's not going to give it to you that easily. There's going to, and this is that same chart we've been looking at, it's going to offer complexity. So here's that same little swing structure here. Here's our change of character. Gives us a demand zone. We come up, we get, if we're going to pivot here, this low does not do its job of giving us a new high. So we get, after the change of character, now I have a downtrend going on within the uptrend, right? We looked at that before. If we're going to return to this here, just because I'm in an uptrend doesn't mean I can't participate in the internal swing structure. I've got a low here. A retrace gives me a lower high. This high does its job, gives me a lower low, breaking the supply zone. If I retrace to it, I know that I've got a stronger high here. If I'm coming back into this is potentially a supply zone to push down to break that low to do its job. Right? It starts to make sense here. And again, it's going to be easier in the line drawing here, but I have to do it this way because when we take it to the chart, it's not as easy to spot. So fortunately, we're going to give you some tools to make it easier for you. So if we're coming out of the demand zone down here, is exactly what you'd hope, right? This is the strong low that gave us the high, right? This is the low that did its job. So here's the demand zone that holds, that gives us the push out of here, that gives us the change of character. By breaking the supply zone, that gives us a new supply zone here. We retrace, I get a demand zone here. I get a pivot that does its job. It gives me a new high. If I come back to that, I know that now I'm in sync with the overall trend. So I have a stronger low here. If I retrace back into the demand zone of that low, I know it's a strong low. I don't know if that's going to give me a new high because it's got to break that supply zone there to do it. We come back up here. We come back into the upper range, the upper supply zone, pivot, change of character. So I get a little downtrend within my uptrend. Now here we go again. I got another change of character here. I've got to get through that demand zone. I come back here. This is the low that gave me a new, gave me the change of character, right? So I have the stronger low within the internal structure here. So this is the weaker high as it did not give me a new low. I come back into that demand zone. I've got to break that high. I've got to break the supply zone. And then ultimately I've got to break the upper zone here, which was tested once, but I can't continue with the trend until I break the structure up here and that trend continues. Right, so it all starts to come together. Now, I'm going to add a little complexity to this. Excuse me, I add a little complexity to this. I want you to look at this for a second because the odds are you're using this without recognizing it already. Right, it's just a matter of qualifying and quantifying and being specific about the swing structure, both the dominant swing structure and the internal swing structure. Now, again, this is that same little impulsive move up, and I've just added a little more complexity to the internal swing structure. See if you can spot that. The only thing I'm going to do here, I'm not going to change anything on the chart. I'm just going to add some labels. Do you see it? So if you're familiar with any of our teachings that we've done here on the crypto space or across multiple assets here where we go beyond day trading and we're looking at 60 minutes and above, you know that we're advocates of Elliott Wave trading and the Elliott Wave Theory approach to the markets here. And again, I've just taken the exact same charts that we're looking at here, and all I've done is just give it Elliott Wave labels here. So here's my impulse here with my little zigzag into my fourth. That gives me the change of character. That gives me the break of structure. That gives me the fifth. That gives me my pivot up here. So I know I've got an uptrend into my impulsive one wave. Now I get a little zigzag on the way down. So here's a little downtrend. Here's the change of character. Well, I get this would be the first change of character. Now we're just continuing in the downtrend here. I get a 5 into an A, which gives me a low. 3 into the B, which gives me another low. So I have a potential low here, potential high here. I don't know the outcome yet. I retrace into this supply zone here, come back down. For this to carry on in this pattern, I've got to break the demand zone here of the A wave. Not to deviate into an Elliott Wave lesson, but I just want you to see this, right? Traders have been using this. They just haven't labeled it this way specifically until it was kind of organized in this fashion. All right, so thus, you can see the attraction is why I was drawn to this and wanted to create this both as for our day traders as well as something for our longer term traders, because you're already doing it. You just don't realize it. So here's my A, B, C. Now note here, I'm below the 50%, so I'm buying at a discount. If this is a 1 and this is a 2, I'm looking for it below the 50. Now I come out of here, I get another little upswing, a little impulsive one here. I got to break that supply zone, retrace here, and I come, now I get a little change of character here. If this is going to be the 1 through a 5, and I'm going to get 3 back down here, I might come into a little demand zone here. Up I go. I'm going to bump into this supply zone here at the 1 of the internal 3 here. Again, I'm assuming if you have any Elliott Wave knowledge here, this would make sense to you. I'm retracing into the 2. Now up I go, and here I even put a little triangle into it because you can see here we're double dipping into that support zone here, and then off we go. I get a break of structure, so the internal trend remains intact. My point being, you're doing this already. You just aren't labeling it this way. And it's just, I think there'll be advantage here to how this can augment how you're already approaching the market. Let me kind of focus in on some of the entry techniques or things that we would look for with regards to now entering, now that we have some terminology and some things that we look for. And again, very likely these are things that you're doing already, perhaps not recognizing that you're using some of these price action or SMC concepts already. So let's keep it relatively simple here. So this being a swing, a retrace, an internal retracement. So it maintains the structure here by staying above the low. So I get a higher low, I get a break of structure. If I'm coming back to that, okay, well, this is the rudimentary pattern here. Now, if you were thinking Elliott Wave, right, what does that look like? Right, looks like a leading diagonal. Not to digress in that, but these are patterns you've seen before. So as we retrace into this, if this were going to be an A, B, C, or a 1, 2, 3 of a diag, we'd want a deeper retracement in the, not to digress there, but same thing up here, break of structure here. This break of structure, we retrace back into that supply zone. This is, there are times the market will give it to you this easily. Not always, right? But you can spot this here, and this will have, of course, you'll have multiple candles coming into this, but I just want your eye to start getting tuned into, oh, wait a second, I've had a break of structure, or could be a change of character. If I'm retracing into that pivot, I want to pay attention here because I have potential, back to where we started, unfilled orders could be there. There could be bears in this case here defending those shorts, looking to break the low. Why would they be looking to break this low? Because if this is going to hold here, if this zone is going to hold, this would be the strong high that gave me the low here. So the target from this becomes the break of that low, because this is the weak low, right? This is the weak high, didn't do its job until it gets here. Now it has done its job, and this becomes the strong high. I think you guys are trying to get that. Now, a little bit more sophisticated here, where we're just adding, well, essentially you would call this a flip. So we're adding a double break of structure. So we're coming down, right, typical swing structure here. I get a final break of structure. So I know that at least at this degree, I have a downtrend. So if I'm going to retrace back into that, well, I'm back into that supply zone here. The anticipation would be that this is a pivot. Because it's a lower pivot, it's going to do its job, right? It has a job to do, which is to take out this low. If it can't do it, Right now I start to come back the other direction. Well, the first thing that's going to happen here is I'm going to have a change of character. We could label that as a failure reaction. But in order for this to carry on, well, I've got to break the supply zone that's right here. So if I'm going to do that here, well, now I've got a break of structure here. So I've had the change of character, and now I've got break of structure. So I have the potential here now for the trend to have changed. If I retrace back down to this demand zone here, I want to pay attention. Right here, I'm just adding a little complexity to what we had over here. And this is the way to look for it, right? And this, again, you're already doing this. We come into a low here. What's the first thing you're looking for if you're considering a potential trend change? Let's say it's 11:15, 11:30. Europe's just closed. You're trading the stock indexes. What are you looking for? You're looking for that first higher low, right? That maybe, okay, maybe that's potential. But this is the very aggressive way to approach that, just off of the fact that, hey, maybe I've got a higher low. Well, you know, of course, if you've done any day trading, you know that could easily just do that, right? There's no guarantees. So the more conservative way to approach this is to wait for the confirmation, break the structure. So this is the start of it. This is the next piece of it here, where if I can break that demand, because we don't know, that could come right back down. But if it breaks there, well, then now things are starting to look better, right? So now if I get this break here, now I'm coming back into that demand zone here. So traders had to get aggressive here. Money had to be committed here to get through that supply zone, because they got to fight the bears that are there to push it back down, because they're after the low. If we break through that, and then if we start to retrace, well, I want to pay attention when I get down here, because I want to look for an opportunity to buy before that low is broken. Because if that low is broken, then I've got a change of character. Right now, it's potentially a demand zone, and I can lean into it because I've had the substructure here set it up, right? So. Right, here's the first, right? I don't get a new low. I get a failure reaction. I break the supply structure here, the supply zone. I get a break of structure. Now, if I'm coming back down, heads up. I want to pay attention. If I can refine that to a zone or a candle or a wick or whatever the case may be, depending on what's there, and if I can get in on the discount range of that range, boy, is my risk reward looking good. Now, of course, this is going to present itself in a variety of patterns here, where you're going to see this here. Again, this is kind of simplified. Here's the first clue that should draw your attention to it. Okay, I got a change of character. Now, what's right here? I mean, you could look at that and say, oh, head and shoulders. You could think Elliott Wave, oh, A, B, C. You could think of it as an FX trader. Well, oh, okay, well, there's an M, right? So there's a number of different ways we can evaluate this, but it's this pattern here. It's the failure to take the high. But it's more than just that. It's the break of the low that leads to the failure to get to the high. Now, right, now you want to pay attention. Same thing here on the other side. Just a little more complexity here, adding now the change of character. So this is a flip with a change of character. And what we're flipping is the short-term trend. So we get the higher high, retrace. Now it's all there, ready to go for the higher high. Doesn't get it. So first I get the failure. Right, there's the failure reaction. So that becomes just the initial first break. Then I get a change of character. Now if I'm coming back to that, if I get this retrace, I want to pay attention here. Because same, right? Unfilled orders, bears defending, target is the weak low, right? You see how it starts to come together? Same thing down here, same pattern here, just on the other side where we've got the failure, the change of character. If we retrace back, I want to pay attention. And it's going to present to you differently, right? It's always going to be, the market's not going to make it easy for you here. So here it is without the change of character. I get a little retrace here, but I don't quite get the change of character yet. But I get a swing, I get a lower low here, I get a lower high. So I have potential here. This is up to the trader's discretion as to whether or not you want to take that trade. Well, at least I'd be buying selling in the premium. My stop would likely be here, depending on what time frame, and can is that an appropriate risk tolerance for you and your account, etc. If we come down, we break that. What's the target? Right, the prior low. And again, same thing over here. Everything here is just inverted, so you can see the other side of it. Now this. You see this in the market every day. It's just here, you're like, okay, I think I know what to say. Well, let's go to the market here and we'll look at some examples. So I'm back to, oh, I think this is the RTY. I think it's a 5 minute on the RTY. I think it's a 5 minute. I'm back to the RTY here. Well, again, here it's a little bit trickier here when you're not looking at a line drawing here. So we see all of the breaks of structure here. This is the one we looked at here. We went uptrend, downtrend, uptrend. Right, a lot of uptrend, downtrend, uptrend, downtrend. No, here we're just consolidating. So here's the range that we talk about. Here's even, you know, the range that we get into. Right, here's my range here. What are we going to do here? There's that same range. We come out of it impulsively. Right, we start. Well, okay, we'll go down to some lower time frames here, and we'll break into this here. But I want to remind you of this structure here because I'm trying to identify that for you on the next chart. So here it is. So we're coming down. Oh, let's see here. It's probably better we do this with the laser so you can see a little bit better. Okay, so we're in a downtrend. Here's the last break of structure here that confirms, okay, I'm in a downtrend here. So I've gone from this high, swing low, higher lows, pardon me, lower lows, lower highs, lower lows. I'm breaking structure. Now, when I get down here, note it's all wick down here. This is, you can see I'm on a 5 minute of the RTY. Now, I come up on the way up, not only I break structure, pardon me, I get a change of character. Additionally, I break structure. Now, remember, the first break is not the trend change. I need the second one. I get it right here. So if I, let's see, maybe if I draw here, so you can see I get a swing, I get a retrace. I get a swing that gives me the break of structure that gives me the new high. So when I come back, what am I looking for? Here's the last little zone, the last down before the up. When I come back to it, I want to pay attention. Is there a potential opportunity here? Right? Well, in this case here, we're just using the last down before the up, the last little supply zone. Well, you can see here, once it was dipped into once already. But here, I'm more confident here because now I've had one break of structure, two breaks of structure. I come up to it. Now, on the way down, I get a little micro break of structure here off of this pivot. I come into that demand zone here. I don't know that that's not going to rocket down. But if I start to see that thing turn around, whoa, heads up. Look at the risk reward there. If my stop is here and my minimum target was right here, well, that's about, it was about $2,000 right there off of a 5 minute chart. Now, would you have stayed long through all of that? Well, you know, this would have been something you'd have been paying attention to, right? Remember, you got to break a supply zone here for that trend to keep going. Risk reward here, I mean, it's so big here, I'll let you do, you know, fill in the blanks there, right? It's about as good as it gets, right? And it all just setting up exactly, there's the line drawing that I just took you through. There it is. Up we go. Let's go forward here, another chart here. So this same chart, right, same section, but I've just gone down to a 1 minute. So here's that same break of structure here that gives us that high that leads to the retrace here. I get a break here. Note, I get one break of structure here, but as I come back down to it, what am I doing? I'm revisiting the demand zone here. Well, you'll note here that we originally came out of this here after I got this change of character right here. I got a high. Now I come back into it via that little zigzag. So down I come, change of character. Right, I don't get a new low, I don't get a new high. I come back into this is the last down before the up. Right, so I get a little supply zone, or excuse me, a demand zone here. We come in, we just barely wick into it. What's my target? Well, minimum target would be this pivot. Right, so up, don't get there on the first time, retrace. Now I get there. So I mean, these are bigger moves than you realize here, right? So even on the RTY, these are fairly big moves. So once I've done this here, now I've got the ingredients of my trend change here. So I've got the double breaks of structure. I get a pivot up here. Oh, there might be some things over here to be paying attention to. Let me get rid of that. But now I'm coming back down. What do I come back to? I come right back to the prior demand zone. I mean, literally a ticket. Now, we can look at that. There would have been another one in here, which, you know, as we get into more examples here, there's some refinement there, and often there'll be zones that'll be very close to one another, and we're going to make it easier for you to identify those. But as we come out of this on the second tap, up we go, break of structure. So here's the first break, second break. So now I know, right? Bryce, you're making it easy for me. I know I've got a trend change. Well, that's about as good a risk reward as you're going to get right there. let's keep going. Oh, now we're over to crude here. Oh, this is a good example here. So here, again, it's a little trickier than just in the line drawings. Well, here, break of structure, break of structure, break of structure, right? So these are all breaks of structure. So clearly we're in an uptrend. Right, that's not too hard to spot that, right? So, but we can be, we're very specific about it, right? Break of structure, break of structure. We know that's a big uptrend, and it continues until I get right here. Now I get the first ingredient. Remember, the first potential that I might be retracing is the change of character. Now I come down, now I get break of structure. Now it keeps going. Now I don't have break of structure here, right? Remember, that's pointing to the right. I retrace in this little 3. Oh, let's get rid of that. Get my laser so you can see it a little bit better. Right, so I've come down. Here's the first break of structure. Now I get this little 3 right here into this. Now I get the second break of structure. So from this pivot, there's 1 break of structure, 2 breaks of structure. So now I have a downtrend. So remember, when we get that change here in trend, what we're looking for is what happens on the retrace. Well, in this pretty nice example, so on the way back, what do I get? I get a change of character. I come into this line. Now here, it's not a break of structure until we get over here. This is just the pivot that led to that. When I get right here, what am I doing? I'm testing the demand zone here that was created. This is the last up before the down that gave me the break of structure. Now I'm coming back to test that zone. Do I know what's going to happen? Of course not. I'm in a downtrend. But so I know I'm in a downtrend. So if I'm retracing here, here's what I know. That this is a strong high because it gave me a new low. It broke structure and gave me a new low. So if I'm retracing here, again, we've looked at this repeatedly through examples. I want to pay attention. It's potentially now I'm coming into that range where I could push down. Not only do I push out, when I come down here, I break structure. Right? So, I mean, again, this is an awfully good, that's about 103.06 to 1, it's about $2,000 right there. I mean, these are big swings, right? And the risk reward, again, the math there would have been very good. If you're buying in the upper half, now if we're selling in the premium zone here, my stop's on the other edge of that. Where's my target, right? This low. That's good risk reward. Coming back the other direction, there's the change of character. I don't have break of structure here. I don't have change of trend yet until I get right here. I still don't have change of trend. I just have my first break of structure. Right? If we're going back that way, well, then there's a change of character and the whole process just carries on. Now, of course, we don't, I mean, while this is intended to augment what you're already doing. Of course, you could trade this exclusively, but we don't want to just ignore concepts and things that we know are real in the market, or other tools, other methods. Certainly, this is if you've followed any of my teaching, where this is I would tell you that's the dominant algorithm in the market here. So here's our measured move indicator that has identified. Actually, I just pulled this off of our toolbar. So here's the swing. So I get break of structure, break of structure. So I know I have a new swing down here of a new trend. Now I'm retracing. So this is the same slide we just looked at, but note what's here, right? So if I take this as the range and this is the low, well, here's 50% of it. So I literally come back 50 to the tick. Well, here's my target, right? Here's the measured move target here. That's the negative 23.6. But in order for me to get there, I have to break the demand zone that's here, that was created off of this lower low that drove it up. Remember, money had to be committed to drive the price up to get to that zone where it's tested. Now, if it's coming back down, first thing it has to do, if it's going to get to that target, has to break that demand zone. And here, I've refined this all the way down to just the wick. Well, we pop there and we get the reaction. That's about a 60 tick move here. So that's about $600 reaction in crude on a one lot. We come right into this massive wick rejection. We come back down for the second test on that demand zone here, breaks it. We ultimately get to target, right? Or to the algo. Algo gets its target. Now we start to come back up here and higher high, higher low, higher high, higher low, higher high. We don't get a break of structure here. It just carries on. But my point here is that this is just one more confluence point here. So you might have been trading that 50, not quite recognizing that, oh, wait a minute, I've got a demand zone here because I've got a break of structure that would suggest that I've got potential for a weak high here because this is a strong high. If I come into that zone, right? So hopefully that's starting to make sense. Here it is on the 1 minute. It's the same trade. It's the exact same section. Exact same section of the trade. I've just gone from the 5 minute to the 1 minute. Well, now here's the 1 minute. We're coming back up, change of character, come right into that zone. Now here I can refine it even further. So if I was looking at this on the 5 minute, and I looked at that range and said, whoa, that's a little much for the risk that I'm looking to allocate to this trade, much as I like the potential here, that's too wide for me. So I can refine that. I can go down to a 1 minute. There's the last up candle before we came down that led to the break of structure, created this demand zone here. When I come back to it now, I'm just down to the 1 minute candle. So I've reduced that risk even further. Right. Oh, you could see if we were just looking at the 3 up candles here, that might be a larger zone. And remember, the 3 candles on a 1 minute may just be 1 candle on a 5 minute as we had drawn it previously. If I go back here, it was just this 1 candle. But if I go forward here, those 3 candles are just that 1 candle. Now I'm down to the very final 1 minute candle here. Again, I'm reducing the risk, but I haven't changed the potential reward. This was always the target. At very least, well, this was the first target. I should say it that way. This is the first target because that's the weak low, because that is now potentially the strong high with that as its goal. Now it doesn't get there the first time. It doesn't break the low to give. It doesn't turn this into a strong high on the first visit. It rejects. Again, that's 60. I think it's 64 ticks off of the demand zone. So at this moment in time, I'm still in that range. Well, here's our range that we looked at. So I've come back to my range here. I get this reaction off of it, but ultimately now I get the break. Come back, now I head back down. Now I'm at the algo target. All right, and off we go. So this area here, this should look very familiar because we looked at that in our line drawings here. Here it is right now. All right, so here's the strong high, right, that leads to the low. We come all the way back. When we get here, we want to pay attention. Right, that's it right there. Here's the, right, I mean, exactly as I drew it, right, taken right out of the market. Now, we don't know, right, if it breaks there, things change. But when we get there, we have a potential trade setup. Here, I'll finish here with crude. Oh, well, at least we'll finish this section here, and then we'll go into the second half where we'll go into the details on the indicator. Kind of same idea here. I'm down to a 1 minute here, so I've got a clear downtrend. I get a swing here. Now I get a retrace here. I don't get a change of character, but you can just look at it and say, well, here's the swing. If this was going to carry on in this trend, the intention was for the swing to retrace and then give me a new low. This is a pivot that had a job to do. It doesn't do its job. This becomes the strong pivot because it gives me a new high, right? It breaks. So we have multiple changes of character here. Ultimately, I get a break of structure here. But note here, once I see this failure swing, right, I have the conditions for the potential flip or trend change. So as I come here, now I've got a higher low, right? Again, this would just be rudimentary price action here. Lower low, lower high, lower low. Oh, all of a sudden I got a higher low. Oh, now I got a higher high. Do I have a potential? Now this is a 1 minute chart. But I've got the potential now. If I come back to revisit that, here's my last little, see, remember we looked at those examples where we could have multiple 1 minute candles creating that zone. Well, when we come back to it, what do? We just put a toe right into it. So you could literally have put a limit order right on the pivot there, right? Stop below the low. Look at what comes off of that. Why? It's the same idea, right? Same thing we've been talking about here. So bulls drive it up here. If we're coming back here, reasonable that there would be, look at this candle here, right? How quickly that moves. Reasonable that there'll be orders here that didn't get filled at the prices traders were looking for. So if we come back down here, potential for those orders to get filled, assuming they're still there. We don't know, right? We don't know for sure that they're going to be there, but we can anticipate that. We know there's going to be defense here of the bulls that drove it up. That's a pretty good sized move in crude. We're going from 101.20 to 102.20. So, I mean, pretty good move there. Granted, we are on a one minute chart. But so as I come back to that, heads up. Right, it's the same thing we just looked at, right? When we come to those zones here, it's just last one was a sell, this is the buy. Now, coming off of this, what's the first thing that happens? Change of character. Then I get break of structure. Then I get another high. Now I get up here and I get here. What do I get? A little range. So I'm back in that kind of consolidation, right? So we've come from, well, you could almost think of this as a range here. We've come from this range here where we're coming here. Now we move out. Let's do it with the laser so it doesn't get too too crazy here. Right? So we could think of this as a range. We come out of that range. We come up here. We get a new range up here where we consolidate. Market's running out of gas. Now we come all the way back down. Now, in this particular case here on the 1 minute here, we don't quite get to this demand zone here. But is this not potentially another demand zone? It absolutely is. So if we look at that and just carry it forward here, now we're going to, so I've just gone over a pivot. Here's the last pivot here. Now I've gone over a pivot, last down before the up that led to the break of structure, right? If this was going to, here's the, well, note here, I almost missed this here. I wanted you to see this. So here's the swing that leads to a new low. So I get lower low, lower high, lower low, lower high, lower low. Now I retrace, I come all the way back to the golden zone. So this is a pivot now where we know there's an algorithm that's participating here that has a target. Its target is down here. So we swing, it heads towards its target, but it gets denied. Why does it get denied? Right? Demand zone here prevents it. Prevents it, right? This demand zone here prevents that from getting any lower, right? Can't get to its target. Oh, look what comes off of it. So when we come back to it, look where the break of structure happens, right? We're happening right at the golden zone, right at the 618 from this pivot. So we break up here, we get into this little consolidation zone. We're coming back. What do we come back to? Right to the demand zone here, where we put a toe in. We come right off of that. First thing that happens, we get a change of character, and it's, well, you can't even see it. So it's a change of character and a break of structure on top of each other. Look at the candle. Right, that's something that you'll see often here. We get this big impulsive candle here. Again, same idea. Likely not every trader got filled at the price they were looking for. What do? We come right back into that demand zone right there. That was right there. Up we go again. Now we come back to it again. Right, up we go. Right. So it just, the process carries on and on and on. Now, what you may not have noticed is that when we were up here in this new range here, when we hit this range, where were we? Right. If we go back a pivot to the last change of character, now here I've refined this on the 1 minute to the wick of that 1 minute candle. Right, that's the last pivot that gave me this break of structure, that gave me this low. Here's the potential trend change. I come all the way back to it, but I cannot break the high. I come right into the wick of that 1 minute candle. Here, I'm not quite there. Little change of character takes me just far enough to get into it. Look at the move that comes off of it. And where do we go? Right back to the demand zone. What do we do there? Up we go. Right, so it's the kind of thing. It's been happening all. If you weren't recognizing this, you were. It was happening on the chart without you being able to identify it, or perhaps not identifying it this way. I guess that's what I'm trying to say. So recognizing, oh, hey, I've got a pivot up here. Maybe we'll come up in here and we'll get a double top. Well, again, we can put this now into a context here that makes sense. So I can understand here if I was looking to be short here, because this is a pretty big rip. What would make you think to be short here? You'd need something other than, oh, there's a pivot there. Right. This is what sets it up, right? The potential, the change of character, the break of structure that takes me up here. Now I'm challenging that supply zone here. Think about the risk reward there on that trade. My risk is here. My target is here. What happens? First thing that happens, break of structure, change of character. These are little micro changes. Here's the final break of structure, confirming the trend change. I come back into that demand zone. Now I come out of here. Right? Same thing happens again. Let's see. If it just further, I went down to a 1 minute here. So here's that section here. We're coming out of this lower. Here's that last high we were just looking at. We come down into that demand zone. We come up here. Now remember, here's a potential range that you could be in. So we've come up here 3 drives. We've come up here. Here's the last high before the low that breaks structure. We come back to it. Right here. Let me get that out of there so you can see it. We come. Well, give me the laser. We come back to it. Darn it, come here. We break of structure, right? That's the first tell. Well, here's the change of character, break of structure. Now I'm coming back to it. I don't know if that's going to hold, but I'm looking for evidence of it here, and I've got the last little up before I come down. So this is the last pivot that gave me a break of structure. I come back to it. Here's the zone. Here's the range. What do I do when I come out of it? First thing I do is break structure. Then I break structure again. So I have on the 1 minute, I have a downtrend now because I've got 2 breaks of structure. I come back, right? This is potentially a low with a job to do. It doesn't do its job. This becomes the week high because it gives me a new low. It breaks the structure here. So I have now I've confirmed 1, 2, 3 breaks of structure. So I know within this section here on this 1 minute chart that I have a downtrend here. Where do I go? Right to the demand zone. So now coming off of that here, and we'll wrap up on this slide. Oh, yeah, I got one more. Well, here's the last demand zone. I come up. Now, note here, I don't do anything here. Even though I get a reaction, and that's a decent trade there. There's probably $500 right there in crude. I come back to that. Let me get that off of there and get the laser. I come back to it, but I don't do anything. I don't get a change of character. It's just it's just a reaction. Now I come back down. Now this is the last low that gives me the change of character, that gives me the break of structure. So this is the low that I want to pay attention to because this didn't do anything. It didn't give me a change of character or a break of structure. This one did. So I want to pay attention to this demand zone here is more important to me than this one. I got a reaction here, but this is the one I want to pay attention to because it gave me the break of structure, it gave me the change of character. Right. So you follow. So we come back up into this. Now remember, we're coming into a supply zone here where you can anticipate that there's going to be some resistance here, just like every other zone that we come into. Well, for this trend to carry forward, it's got to break this supply zone. Here's the break of structure. As we get through it, it stalls for a second, right? You know there's going to be a fight here, but it carries on. Right, so this is the important low when I'm looking at my potential retracements and targets. And if you were using any of our tools here, or the auto fibs or measured move indicator, it's going to identify that 50 for you, so you would know it was there. Now with these tools here, we're going to make it easy for you to identify that that's the demand zone that you want to pay attention to. We come right into the 50. Where do we go? Right to the algo target. And along the way, we break structure twice, right? Do you see, in order to get there, it had to break this supply zone. It had to break this supply zone. So as we're going into that, and what do we get? We get it to the tick. And if you miss this one, if you thought, God, look at that one. Oh man, I just barely wicked it. It was right at the 50. I was trying to buy in the discount zone. I missed that one. Well, did you not get another one? Right, this one here, we got this potential pivot here. We don't know. This is a retrace. That's a lower high, has a job to do. Can it get the new low? No, it can't. Right? What does it run into? See, here's the last one we just looked at. It didn't quite get there. It ticked the 50. It ultimately got to the algo target. But if you missed this one, don't fret, right? Because I got a change of character. Now I'm coming right back into this one. Last down before the up that gave us the change of character. We come back to it. Now I'm going to be a buyer. Right? How's my risk reward look there? Right. So if you start to stack these together, you're going to see they're all over the place. It's all over the place. So then it becomes a function of which one do I want to take? And then we're back to, okay, am I buying in the premium or the discount? What's the last thing that happened? Did this lead to a break of structure, or a change of character? So there's a refinement to the process because there are going to be supply and demand zones all over the chart all day long. So we want to use this in conjunction with some of the other tools. And I'm not suggesting you replace what you're already doing. What I'm suggesting is that this is another set of tools, another way to look at the market that can add some value and give you some terrific risk reward setups. Right? So with that, let me wrap up this section because I know I've gone very long here, but I think hopefully you're starting to see the potential here, and we go into the second half of it. We'll dig into the details of the indicator and how this can be helpful to you. Okay, we'll wrap it there and we'll carry on in part 2.